Okay, so welcome to the last session, just before we have the panel. So this is going to be a session that includes a paper by Javier, Bianchi, Pablo, Ottonello, and Ignacio Presno. As you say, since we'll be all talking about Guillermo and students of Guillermo and students of Guillermo, and someone was mentioning yesterday this intellectual father, I guess it's the time of the intellectual grandchildren to speak and to start seeing what the younger generation is doing. So I promised you yesterday that as I was talking about Goya and things I was learning from Guillermo, that my contribution to him was to talk about Calvin and Hobbes. And someone stole the mouse here. Oh, it's on the drawer. So this is, so we're doing this paper on Mexico, and as Carmen was suggesting, actually when we first worked on the paper in Mexico, it wasn't that well received in the sense that people always wanted to think that the Mexican crisis was just like another one of the ones we tended to have every 6 years. So we're talking about all this stuff about stocks and debts and so on, and some people were listening, but a lot of people were not listening. But I was very optimistic, so I was thinking, you know, this is going to be great, and we're going to win the Nobel Prize. And then Calvin and Hobbes came out with this thing, and I thought this is the last of the strips. So Calvin says, we'll win the Nobel Prize, get rich, and go on talk shows. And then Hobbes says, but what about the babes? When do we get those? So that's Calvin and Hobbes, and so I get Goya. I gave him this. So the floor is yours.
All right, so good afternoon, everyone. I would like to begin by thanking the organizers for such a fantastic conference, Martin and Andy, and also for including us on the program. I enjoyed from this conference not only having seen so many great papers and policy discussions, but also have seen everyone's stories about Guillermo and see how much influence it has had on all of us here. In my case, as I mentioned, it's impossible to overstate the influence that Guillermo had on my work and on life in general. And hopefully this paper is going to be a piece of it. So this paper is called Fiscal Stimulus Under Sovereign Risk. It's joint work with Javier Bianchi, who is here, and Ignacio Presno, another Uruguayan too. So it's a Uruguayan team. So the motivation of this paper is that there is a long-standing view in macroeconomics that fiscal policy should play a stabilizing role over the business cycle. The textbook Keynesian argument is that by spending more during crisis, governments can pop up demand and stabilize potential increases of unemployment, and that is an argument that is made particularly when monetary policy is constrained, for example, in a fixed exchange rate regime. Okay, so this textbook policy recommendation usually is in sharp contrast with what countries actually do in practice. And in this plot, we have a paradigmatic case of this, which is what countries did with their fiscal policies, in particular where their government spending during the Euro crisis. Okay, we have here 5 usually study economies in the Euro crisis. On the left panel, we have the unemployment rate, which has been increasing, started in 2007, 2008. And the right panel shows that in contrast with the standard Keynesian argument, these governments have been declining their spending. Okay, so what we want to bring to the table is a third variable here, which is the behavior of sovereign spreads measured here as a yield that these economies pay vis-a-vis the German bonds. And what we see is that these economies have been experiencing increases in their borrowing costs with which governments have to finance potentially this fiscal stimulus. And this is what we want to ask, whether these increases in borrowing costs and sovereign spreads could be linked to the behavior that government spending has. Okay, more broadly, we want to provide a framework to try to understand the question of what is the optimal policy that governments should conduct during sovereign crisis or during periods of that exhibit increases in sovereign risk. Is it stimulus? Is it austerity? And under what conditions do we have one or the other? Okay, we're going to be doing this in 2 steps. First, I'm going to show you empirical evidence characterizing the dynamics of fiscal policy during recessions. Here we find that economies that have high risk and high debt tend to exhibit fiscal austerity. And then we're going to provide a model that rationalizes this as the outcome of an economy that has sovereign risk. And we want to construct here an economy that in principle has all the Keynesian channels at play. Okay, so we're going to deliberately build an economy where the Keynesian channels are strong and we have large fiscal multipliers. But what we show is that when sovereign risk enters into the table, the optimal policy becomes pro-cyclical of declining government spending during downturns, as we see in the data. And we also find that that's something that is contingent on the state, and in particular, when debt is low, we still see some optimal Keynesian policies that can be conducted. All right, so the overall takeaway is that commitment and debt play a key role in the design of fiscal stimulus, something that I'll call like a general Calvo lesson, as was summarized today, for example, by Carmen and Maury. So, you know, there's not kind of one paper that can be pointed out to this, but mostly to a general work on the role of commitment and financing frictions and debt more generally. All right, so our paper mostly relates to the literature on fiscal policy multipliers and sovereign debt, which in the interest of time, I'll start with our paper. Okay, so let me start with some empirical analysis. Here, the idea is to provide some descriptive evidence that shows how countries conduct their fiscal policy during downturns. Okay, so for this, we do a simple empirical analysis that has a panel of 100 economies around the world between 1980 and 2016. We use national account data to measure government consumption and GDP. And with the algorithm that we have for the paper with Guillermo and Fabrizio, we identify 570 recession episodes, which you can think as periods of downturns or contractions of annual GDP. Okay, then we have measures of sovereign risk data with credit ratings or historical default dates as collected by Carmen and Rogov. We also have data on net foreign liabilities and another country-level institutional variables that have been pointed out are important determinants of fiscal procyclicality, such as income per capita, corruption, ethnic fermentation, or rent from commodities. Okay, so with this data, what we do is to provide descriptive evidence on output and government consumption dynamics during recessions for countries with different levels of sovereign risk. Okay, so in particular, we estimate this Jordan style of local projections. On the left-hand side, we have cumulative changes of a variable of interest, which can be GDP or government consumption. On the right-hand side, we have a dummy variable that takes a value of 1 if a country enters a recession in period T. Then we have the interaction between a recession and the level of risk of the economy. Think about this also as the dummy variable. And then we have another interaction between the recession risk and the level of indebtedness with which the country arrives to the period. Okay, we include there another set of controls to try to absorb other potential differences that are unrelated to potentially to risk. Okay, so let me begin by showing you how the anatomy of a usual recession looks like for an economy that has low default risk. Okay, think about these as, you know, very low risk economies. On the left-hand side, we have the dynamics of GDP. These are cumulative changes since the beginning of the recession relative to trend. And, you know, by design, we're analyzing recession episodes, we see a contraction of economic activity. On the right panel, we have the dynamics of government spending during these episodes. And what we see is that these low-risk economies tend to follow something aligned with the Keynesian policy prescription of increasing government consumption during bad times. Okay? Now, this perspective changes substantially if we put into the picture sovereign risk. Here we have on the left panel the interaction, we are plotting the interaction between recession and risk. So you see that economies that have substantial amounts of sovereign risk follow a different pattern and decline their government consumption during economic downturns. And on the right panel, you see there that the more indebted the risky economy is, the more it contracts its government spending during downturns. Okay, so these are kind of the key patterns that we want to take to the model. And we not only analyze recessions, but we also do these kind of in a more business cycle type of perspective. So we study the fiscal cyclicality by regressing the changes of government spending onto the changes on GDP, and interaction of GDP with risk, and interaction of GDP with risk and debt. And what we see here is, consistent with what you see in economic downturns, an important part of the fiscal procyclicality that we see in the data that has been documented in the literature is driven by economies that have substantive amounts of default risk. And this is not, again, absorbed, it's descriptive, but it's not absorbed by other potential variables that one can have in mind that might be correlated with default risk. Okay, now, with these facts, I'm now going to start describing a model. And here the perspective of the model is whether we can construct an environment that can rationalize these type of facts through identifying some potential frictions that the government can face, and in particular through frictions of sovereign risk. Okay, so I'm going to describe the model structure in three main blocks. First, we consider a canonical small open economy with trails and non-trailed goods. We have stochastic endowments for trails, and the law of one price holds for these goods. And we have the production in the non-trails conducted with labor. Okay, so here, if you want, we want to be as canonical as possible to embed this into a kind of a textbook trail and trail style of model with some additional ingredients that I'm going to describe as we go. Okay, so we have households that have preferences over the consumption of the private good, which is an aggregator between trails and non-trail goods, and the public good, which is a government spending in non-trail goods. Then we have, as I'm going to describe in a little bit, that households can be either employed or unemployed. If they are employed, they receive the wage from their labor supply. If they are not unemployed, they do not receive a wage, but there is potentially some government transfer that can be made, that the government can transfer money to unemployed households and collect funds from employed households. Okay, that's kind of the household side, and something that important that this gives us is a standard optimality condition in international macro models, which is that the relative price of non-trail goods is equal to the marginal rate of substitution between trails and non-trail goods as measured by the ratio of the trail to non-trail consumption. All right, so on the firm side, we have a very simple static firm problem. Firm produces non-trail goods using hours as input. From the firm side, we have now an optimality condition linking the marginal revenue product of labor to the wage measured in units of trails. So here, I want to highlight the role that this relative price between trails and non-trail goods or real exchange rate plays by shifting the labor demand. All right, so far, a fairly canonical model in open economies. Now, the second block of the model is what we call the Keynesian block. And here what we follow is the structure of Schmidt-Grohe and Uribe's downward nominal wage rigidity. And the reason for following this is to introduce a Keynesian channel for stimulus that is potentially quantitatively large. Okay, so Stefan and Martin have shown that this type of wage rigidity, coupled with a non-racial labor market, can lead to large welfare gains from stabilization, large welfare losses from unemployment. So again, the idea here is to consider, to give all the potential benefits to Keynesian side of the model, and that's kind of to consider this type of wage rigidity. Okay, labor is indivisible, so there is a rational and idiosyncratic income risk. Okay, so in particular, the type of wages that we're going to be considering is going to be a nominal wage rigidity, in which wages cannot be less than some minimum wage W bar. And then there's a rationing rule that tells us that actual employment is going to be the minimum between the supply that we normalize here to 1 and the demand coming from the firm side that I just showed you. Okay, there is this unemployment insurance that I'm telling you that we allowed to have into a model, but we impose that this has to be balanced budget, and that is whatever the government collects from taxing employed workers has to be transferred to the unemployed workers. It's just to separate this unemployment and insurance from other type of stabilization. Okay? And then finally, we have here the sovereign risk block. And here we are again trying to be as standard as possible. So we follow the Eaton-Gershovitz tradition in the quantitative versions that have been considered, for example, by Cristina Arellano, Mark Aguiar, and Gita Gopinath. We are here, again, as canonical as possible, governments that borrow from the rest of the world in long-term bonds with promised payments that are not contingent. We have international investors that are risk-neutral and competitive, and a government that lacks commitment and perceives some cost of default. Okay, now, to study the optimal fiscal policy, we consider a government that spends in non-tradable goods, and the reason for doing that is precisely to introduce a rationale of why you would like to be Keynesian. We need to introduce some limits to taxation. So the external borrowing is a marginal source of financing, and there is a meaningful trade-off with sovereign risk. And we also introduce limits to monetary policy, and in this case, we consider an economy with a fixed exchange rate regime. All right, so let me give you some additional details. With this in mind, the government spending is going to be financed with a constant tax on income, and that constant rate is tau. This can be relaxed, and we do it in quantitative versions if you allow taxes to move, but you impose some cost to do that. Most of our conclusions are preserved. And non-state contingent bonds and the units of trade. So we have here, the first equation shows you the government budget constraint if the government chooses to repay. So on the left-hand side, we have government spending in non-tradable goods. We have the transfer that the government does to the household and the coupon payments. On the right-hand side, we have the taxes that the government collects and the issuances that the government has at that endogenous object, which is a bond price Q. If the government chooses to default, it does not have to repay its coupon, but is temporarily excluded from financial markets, so it cannot issue that into that period and recovers probabilistically, re-enters the market. And then there is a state-dependent utility loss from default, which we parameterize to make them all be consistent with key data patterns. All right? On the rest of the world, we have these risk-neutral and competitive investors that gives rise to a standard non-arbitrage condition between risk-free bonds and government bonds. So from this, we know that the bond price Q is going to reflect the probability that the bond repays tomorrow and the future prices of these bonds. Okay, so every time that the government wants to issue that, it's going to internalize the fact that it has on these bond prices. Okay, given this, let me take one step back. I have been describing you these three blocks, but to give you a definition of equilibrium. So given these exogenous processes from the tradable endowment and re-entering potentially to the market, and given some government policies defined by government spending, choices of debt and choices of default, an equilibrium is given by an allocation for households and firms and prices such that households and firms optimize, the government budget constraint is satisfied, the non-tradable goods market clears. Okay, so this is going to be a key condition that I'm going to be coming back. So the private consumption of the non-tradable good plus the government spending on non-tradable good has to be equal to the output of non-tradable goods. The labor market condition equilibrium holds. And then remember that we have this rationing labor market with a downward nominal wage rigidity. And then there's a bond pricing condition that is satisfied. In this environment, we are going to study the Markov equilibrium. Perfect. All right, so what do we assume for the government? So we consider a government that is benevolent and utilitarian. So the government per period payoff is going to be a combination of the utility that the employed households have and the utility that the unemployed households have. And we can re-express, given our assumptions on preferences, we can re-express this utility function as the utility of aggregate consumption from the aggregate tradable and non-tradable consumption and an inequality concern that is increasing on the level of unemployment and depends ultimately on what is the unemployment insurance that this economy has. Okay, so with this in mind, think that the government arrives to a period, and the first thing that it chooses is condition on the aggregate state of the economy's realization of the tradable endowment and condition on the debt that it arrives to the period which it decides whether to repay or to default by comparing the value of repayment and the value of default. So what is the value of repayment in this environment? Well, the value of repayment is given by the max choice over government spending, borrowing, how much employment you want to have, and how many transfers you want to do. You have a period utility. Here, note that we have replaced the market clearing condition for non-trail goods. So your utility comes from whatever you consume for trails and whatever you consume for non-trail. That depends in terms of what's the employment in the economy and what's the spending of on non-trail goods. And the utility of the government spending good plus some continuation value. There are three constraints here that the government faces. First, the government faces a resource constraint of the economy that tells us that trail consumption is going to be equal to the trail endowment plus whatever resources the government borrows from the rest of the world. A second condition is the government's budget constraint that I just already described. And the third condition is the downward nominal wage rigidity that tells us that the marginal revenue product of labor cannot be less than this minimum wage expressed by W bar. Okay, here I want to start noting what is a trade-off that arises in this environment for a government. So note that on the one hand, every time that the government increases its spending, what it's going to be doing is to increase this relative price of non-trail goods and therefore relaxing the wage rigidity whenever it's binding. But on the other hand, whenever the government increases its spending, it's going to be financing somehow. So therefore, it's going to be tightening its budget constraint. Of course, there are going to be direct utility from spending that is coming in, and this utility that it crowds out the consumption of spending.
So the last one is another constraint.
This is just the expression for the relative price of non-trail goods, which tells you that the price of the non-trail goods is equal to the marginal rate of substitution between trail and non-trail, and we're imposing the market clearing condition here for non-trail goods. Okay, so it's just kind of this. I'm defining the pricing function there. If you want, it's an extra condition. All right, so with this, how we can characterize the trade-off that the fiscal policy faces? Well, we can characterize it with the optimality condition from government spending, and it's the combination of three terms. Okay, so first think, in the absence of financial frictions for the government, in the absence of nominal wage rigidity, what would the government want to do? Well, it will follow a Samuelson rule, so it will equate the marginal utility for consuming this public good to the marginal cost that is entailed because it crowds out the consumption of the non-trail good. The second term tells us that if the wage rigidity is binding, there is going to be an extra benefit from stimulating the economy and for producing more units of the non-trail goods. And the third term tells us that in this environment, the government actually faces its budget constraints, a separate constraint, so it needs to finance these with external debt, which is itself costly. Okay, so to give you kind of a figure describing this trade-off, so here we're doing one period deviation from the market perfect equilibrium. I'm going to already provide you more details on the quantitative side on the few slides, but just to provide you kind of a graphical illustration of this trade-off. We are starting from the optimal point, that is the dot, the blue dot of what will be the optimal choice under this trade-off. And then we're varying the current government spending on the horizontal axis, and then we're showing different variables on the vertical axis. So what you see here is that as the government increases its spending, it increases the relative price of non-trail goods. That decreases unemployment. Okay, so that's the Keynesian side of the model. But on the other hand, it needs to finance that with external borrowing, and that increase in additional borrowing is going to be associated with an increase in spreads. Okay, so that's going to be the cost side of the sovereign risk. Okay, so now what we do is to parameterize this economy, and our idea here is to study whether a quantitative version of this model that is consistent with key patterns in the data can rationalize the type of policies that we observe in the data and that I was showing you initially in the empirical analysis. Okay, so how do we do this? So we take Spain, which is a classic economy that had sovereign risk, that had a fixed exchange rate regime in the period that we were considering, and that has arguably labor market type of wage rigidities. And then we calibrate this economy And this here, we are being fairly standard. So, there are fixed set of parameters that are standard in the literature, such as those of the risk aversion, intratemporal elasticity, the technology, the risk-free rate, and the aggregate shocks. And we calibrate the rest of the parameters of the economy so that it resembles the Spanish economy in key dimensions. So what are these key dimensions that we want to focus on? Well, we want to focus on an economy that is consistent with the level of spreads that we see in the data and with the level of indebtedness that we see in the data. This is very important because it's going to tell us if we consider an economy that has realistic levels of debt and realistic levels of risk, what would that economy choose to do? Okay? And then we also want to be realistic in terms of what the typical level and volatility of the government spending is, and we have parameters associated with government preferences that we can connect to that. Okay, so I want that we think about this again as a laboratory economy in which we can now ask, what would a government do optimally with its government spending, and in particular with its conduct of fiscal policy? Is it pro-cyclical or is it counter-cyclical? So here we have a table describing the correlation between the spending on government consumption and GDP. The left number is the one that we see in the Spanish data. It's a positive correlation of 46% showing that in the data, the Spanish economy is characterized by a pro-cyclical government spending. The second line shows you that in this economy that we calibrate, we also observe that the government will all optimally be pro-cyclical in the same direction as we see in the data. And what I want to highlight here is that this pro-cyclicality of optimal government spending is driven by default risk. If we consider an identical economy, but in which the government accesses risk-free debt, the optimal government spending will be heavily Keynesian. And this is what I was telling you, that we deliberately constructed this economy. Okay, so the optimal government spending in the absence of default risk will have a negative correlation with GDP of 81%. Okay? And how can you see that? Well, here we're tracing the policy functions. So on the horizontal axis, we have the trail endowment, with which the economy arrives to the period. And on the vertical axis, we have the policy functions for optimal government consumption. So you see first that if the economy is risk-free, as the trail endowment declines, so does the optimal government spending. And here, what is providing a rationale for the government for doing that is exactly the textbook Keynesian channels that I was describing to you before. The trail endowment contracts. The firms face this downward nominal wage rigidity when their price declines, so there is unemployment. The government tries to spend more in stabilizing unemployment by doing that. What you can see in the dashed blue line is that the economy with default risk first does the same, but then realizes that it keeps on spending, that is going to be associated with an increase in spreads, an increase in risk, and therefore starts optimally declining its government spending, which leads to this pro-cyclicality of optimal fiscal policy. All right, so I want to show you one more result associated with this, which is now if we consider what is the optimal response under different levels of initial indebtedness. Okay, so here we're doing impulse-response functions to a negative shock to a trail endowment. And we are starting by tracing the dynamics of variables of interest. We have here unemployment, government spending, the real exchange rate, indebtedness, trail consumption, and spreads, if the government starts with low levels of debt. If the government starts with low level of debt, you can see that the government behaves as a Keynesian type of government. You can see that the government increases its consumption. And the government does that by increasing its debt, and as a consequence of both the decline in the trail endowment and the increase in borrowing, spreads do increase. But the government gets to stabilize the fluctuation of endowment. And you can see that the resulting unemployment that is coming from this non-well-rationed market is fully stabilized by the optimal government spending. However, if you start with an economy that has high levels of indebtedness, and this is the red lines that we are introducing here, you see that the government is reluctant to engage in such Keynesian policies. And what you see is that actually the government declines its government spending. And the reason for doing that is precisely that the spreads are increasing because of the higher initial levels of indebtedness that the government brings to the period that is associated with much higher default risk. And as a consequence of not only the fact that the government does not stabilize the shock, but the government actually contracts its spending, there is a much larger increase of unemployment on impact to this change in external conditions. Okay, so you can see how different the policy is depending on the level of indebtedness with which the government arrives to the crisis. If a crisis hits and there is a low level of indebtedness, the government is engaged in stimulus. If it has high levels of indebtedness, it is pro-cyclical. Okay, we also analyze in the paper several other variants of the model and also the possibility of fiscal programs. So here's something that we learn working in these models is that these fiscal programs have to be subtly implemented, taking into account precisely the original problem of commitment from the government. So for example, if you start from a current period and you just consider decreasing spending in the current period and reverting back to the Markov perfect equilibrium from T+1 onward, this is always welfare reducing and can actually precipitate default because as you force the government to reduce its government spending, the government is not gaining something necessarily in terms of commitment for the future period, so that can actually be precipitate default and be welfare reducing. Now, if you do allow here, for example, for a one period commitment for next period, that goes a long way actually increasing welfare. And if the government can promise that the following period is going to cut its spending, that is can go a long way today, increasing spending and actually avoiding a crisis. Okay, so to conclude, sovereign risk makes fiscal policy highly procyclical, despite of large fiscal multipliers. When debt is low, stimulus is optimal. And this means that recessions are likely to be more severe when there is fiscal space. Okay, we also explore, as I was telling you, fiscal rules. And overall, I think this highlights and kind of the commitment and indebtedness play in the design of fiscal policy, which again, it's, I think, a very Calvo-esque type of conclusion. Thank you very much.
First of all, thanks to Andy and Martin for having me. It's been a pleasure not only to read the paper, but also to be able to join this 3 days over here. It's a pleasure to honor Guillermo. I'm one of the few, I guess, that have only had the opportunity of learning about Guillermo from his ideas, from his papers, but not in person. However, I think I represent a lot of people out there that have been very impacted by your work without necessarily knowing you personally. And I wanted to highlight that before coming here, I already knew he was an intellectual giant. That's no news to anyone here. But what I have been learning these days is that he has an incredible human dimension that all of you have been sharing. And I think this is important because as a newcomer to a profession that sometimes feels a little bit lonely, I would say slightly competitive, it is very reassuring and very hopeful that to learn that a person like Guillermo has been able to kind of expand the research frontier constantly, while at the same time having such an incredible human and personal impact on those of you that have surrounded him throughout the years. So while I think it's fair to say that there's no point in trying to match him on academic accomplishments, what I do hope is that when I look back on my research careers in years to come, I'm able to do so surrounded by a group of loving family members and friends, such that the one that you, together with Sarah, which I've also learned about these days, have been able to create throughout the year. So thank you all for also sharing this personal side of Guillermo. And now, back to work. So let me just summarize the paper. The motivation is pretty straightforward. We know from new Keynesian models that we should be, or like new Keynesian models and like IMF recommendations that a government should be implementing countercyclical fiscal policy. However, when we go to the data, we see what most governments do in practice. It happens that they tend to implement fiscal consolidations in times of crisis. So what this paper is really going to be talking about is trying to reconcile the empirics with the theory. And to do this, they're essentially going to be focusing on how default risk shapes optimal fiscal policy. And I think of the model, and part of the presentation that Javier has done, it kind of follows the structure, has 3 different parts. The beginning, they build a model of sovereign default with nominal rigidities, and they solve for a Markov equilibrium where the government chooses government policy sequentially and without commitment. And they highlight that there is this trade-off when it comes to public spending between, the welfare-enhancing stimulus or, stabilization effects of government spending with the financial stress that comes with it when it is associated to increasing borrowing interest rates. They then take the model to the data, and for that they use Spanish data. And the whole point here is to quantify to what extent we observe this trade-off and which of the 2 effects is going to be dominating. And basically what they show here is that a model with default risk is able to match the procyclicality of fiscal policy that you can observe in the Spanish data. And not only that, but a lot of the volatility of unemployment that characterizes the Spanish economy during the last 20 to 25 years. And then the last part, which was presented at the beginning, they kind of extend and they show that the findings are consistent with, there's more empirical findings that kind of this predictions of the model go beyond the Spanish economy, and they document the dynamics of government consumption for during recessionary episodes for a large set of countries with different sovereign risk. So before I go on my remarks, let me, full disclosure, I'm a big fan of Javier and Pablo. Sorry for that. Javier and Pablo's work. So of course this is not an exception. This is a fantastic paper because it's a combination of a timely question. We're at records of high-level sovereign debt. And because of the way they put together this very intuitive, it's a very simple, cohesive argument, and they can go and explain it, first of all, intuitively, but also quantitatively. And then on top of that, the conclusions, the results that they have are very important for policymakers around the world. The caveat is that, unfortunately for me as a discussant, fortunately for them and for the research frontier, I'm not the only one that thinks that the paper is great. It happens that a bunch of anonymous referees, and actually also Harald Ulig, believes it's a great paper, so it's already accepted for publication at the JPE. That means that I'm not going to spend a lot of time giving constructive criticism. Most of the time that I'll be having today, I'm going to go a little bit deeper into the mechanism. I'm going to be focusing on one of the equations that Pablo has been putting up. And then at the very end, I'm going to give a couple of ideas on future research, because I know they have an agenda exploring more work. Okay, so the gist of the paper, or the gist of the mechanism, is very elegantly summarized in one equation that corresponds to the first-order condition of government spending. What I'm going to do is I'm going to go step by step building it up, and at the same time I'm going to be layering a model with the different assumptions that you need to get each of these components. So we're going to start with a very, very standard small open economy. All we need is tradables and non-tradables. The tradables, we're going to think of them as stochastic endowments, and the non-tradables are going to be produced. We're going to be using labor, which is going to be inelastically supplied by households, so there's no labor decision. And maybe the only caveat is that we're going to have public spending on non-tradables, and that's going to generate a utility for the consumer, so it's not going to be wasteful. With that in mind, we would have a standard Samuelson rule where public spending will have to balance the benefit of that additional government spending with the cost of reducing private consumption. They then add an additional layer, which I call the real wage rigidity, which is basically combining the same way that Martin and Stephanie do in their 2016 paper. They combine a downward nominal wage rigidity within fixed exchange rate, so that the real wage, and real here is in the price of of tradables, it's going to be fixed. That's going to generate involuntary unemployment or slackness in the labor market, and it's going to give rise for this stimulus channel that has a lot of a Keynesian flavor. Because basically, when you increase government consumption, you're going to be increasing employment through aggregate demand. The only cost associated to this mechanism is that when you have decreasing returns to scale, the only way you're going to be able to generate this increased production comes through an increase in the price of non-tradables. And of course, increasing the price of non-tradables through expenditure switching is going to crowd out private consumption on non-tradables. But this is not going to go one for one, so overall, this real wage rigidity is going to generate a positive stimulus effect. They are quite generous in trying to pump us as much as possible. This is stimulus channel. So on top of the real wage rigidity, they incorporate imperfect unemployment insurance. What this is going to give you is there's going to be dispersion on employment, which is going to give rise to inequality concerns. So this is an additional channel through which it's not that you want to increase employment because that's going to increase the consumption, but also because it's going to reduce the dispersion of employment that's going to be welfare enhancing. It's hard to see here directly because you would need to, in the second term, you would need to have the first order condition with respect to labor, but you can see a little bit of it through the omega function that's kind of multiplying the utility function with respect to the derivative with respect to non-tradables. What's the third element? It's gonna come from a financially constrained government, and this is what they call the austerity channel. How they're gonna do this financial constrained government, they choose to go through the route of, we know we need financial frictions, there's limited commitment for them, and they're going to put a limit on how much lump sum taxes this government can generate, so that it's really the margin, you have to increase your borrowing if you want to expand consumption of non-tradables, and that's going to come at the cost of interest rate spreads. So higher government spending here is going to tighten the borrowing constraint, is going to do it directly. The more you consume, you have to pay a price for it, but also indirectly through general equilibrium effects, which are the last terms of the equation. The final bit is connecting how much this financially, how much is the tightening of the financial constraint depends on the degree of default risk. And to see this, you have to go directly to the Euler condition of the government's problem. And basically what the Euler condition is going to tell you in a very standard way is that borrowing one additional unit today is going to relax two constraints, today's government budget, but also a resource constraint for non-tradables, because remember for tradables, for non-tradables. But at the cost of tightening both of these constraints in the future. And the mechanism is going to be such that when there's an increase in borrowing, this is going to raise default risk significantly, and it's going to make borrowing more expensive, and therefore overall spending is more expensive, because that's the only way you can finance it. So that's kind of the summary of the paper. Let me take two notes on things that I would like to see next. First reflection is that I was a little bit unsettled when I saw this paper, given the current situation and the high levels of public debt around the world. So given where we are, the obvious question, and maybe Pierre-Olivier kind of would raise it up as he did, I think, a couple of presentations, what should policymakers do at this stage? There's one kind of ex-ante route in this direction, because we have two occasionally binding constraints, so there seems to be precautionary motives that would be easily built in if they're not there. First of all, because there's incentives for the government to create fiscal space ex ante, so that when they reach the situation where they have to decide fiscal policy in a recession, they're not going to be so much cut back by the accumulated debt. The other kind of avenue of research would be accumulating reserves in good times. The second avenue, when it comes to precautionary motives, has to do with the negative externality that Stephanie and Martin kind of discuss in their paper. You don't have it directly, or you don't have the dynamic aspect of it, because for simplicity, you keep the nominal exchange rate fixed at that level instead of making it fixed at some past period. So I think incorporating that dynamic might be interesting in seeing how it plays out over time. Coming from Spain and from Europe, like, the obvious question is, how do we think about, once we're in a situation like the one that Spain was, what is the optimal design of emergency lending? I do interpret the kind of rescue package as a reduction of lump sum taxes, combined with some sort of fiscal forward guidance. I was, that would be my way of putting in the model. I don't know how you guys would see it, and whether there's something to say on what exactly the right combination of these two things would be. Last but not least, and going back to the topic on rules, it seems like the obvious candidate is fiscal policy rules that depend on default risk or things that can be easily measured like debt levels or interest rate spreads. And the other comment is more on we have this overhang problem and the state dependence. We don't really talk about private debt in the paper. You do have an extension where you incorporate household borrowing, but the idea is that the trade-off is still there, and it's undoing part of the effect, but not much. But I'm very kind of curious to know whether the composition of debt, whether it's private or public, it's going to matter in shaping the cyclicality, meaning this sort of state contingency. And the reason is because Spain looks very different when it entered the great financial crisis. It had very low public levels of debt. It increased over the first part of the crisis, but it was most on the deficit side, not on the debt. But the real problem was high private debt levels, whereas now, after COVID, public debt is beyond 100%. So is this going to put the policymakers in a different situation? When thinking about this, I might think more moving to the production side when thinking about private versus public. And there's a literature out there on looking at a pass-through between sovereign risk and financing from firms and how does it impact investment. There seems to be a very similar trade-off, that the one that you've described on the consumer side. But then, it can become a little bit more interesting when you think about banks, and in particular in a currency union like the Eurozone, if you start looking at the diabolic loop. So I'm going to leave it here. Take away, it's a very important state-dependent result. This idea of the cyclicality of fiscal policy varies with debt levels. It's a must-read. I really encourage you all to check it out. Thank you.
Thank you, Laura. Thanks a lot. So we have about 9 minutes to take some questions. Let me take my privilege as chair to ask you a quick one. So I thought in this model you would have a part of the default cost that's endogenous because the output of the non-tradables falls. So I wonder if you look at it, to what extent the exogenous part of the default cost, the one you put into utility, was still necessary after that. Let me collect some 3 or 4 questions because we will run out of time, and then you can answer them. So any other questions? Fernando?
So I thought the graph was fantastic. Also, the graph that you show with not really an equilibrium graph, but I thought it was super illuminating. I don't know where Pablo is. But anyway, so, sorry. the one in which you have the kind of nothing that happened in equilibrium. You just put yourself in equilibrium and you show whatever else would have happened just to understand what's going on. I guess you first compute equilibrium, then you go through all this off equilibrium stuff. I think, I don't know, I just want to remark it because it was really nice to understand the logic. And the second question that I'm sure this is sort of in the literature, my own ignorance, just to explain also in both cases, in some cases I would expect it to have like the decision rules would have been kind of flat because the constraint did not bind, and then we'll have like a kink, and then it will bind, and then you will use it. But the dynamics, in both cases, with and without the sovereign debt, but the dynamics, even in the case without the sovereign rate, do you have a slope on the optimal decision rules? There must be some dynamics, like, for instance, in the decision rule of the optimal G, as a function of Y, as you vary Y, even in the case in which you have risk-free debt. So maybe if you could expand, you didn't have time to.
Other questions? Anyone else has questions? Oh, we have one more here. Please go ahead.
If you think of, rather than in a Keynesian rule of spending when the economy is tanking, if you think of a cyclically adjusted budget rule, you can probably get away from the problem of rising spreads on your debt. Would you have some comment on that?
Okay, Pablo, so you want to take 5 minutes, up to 5 minutes? Yes, thank you very much, first of all, to Laura for an excellent discussion. We like a lot some of the suggestions that were mentioned. We are actually currently working on two directions that are actually connected to that. One that I would like to highlight, which is also connected to the last question about fiscal rules, is that we did try in this paper to study fiscal rules. And fiscal rules in the current environment do not turn out to be optimal. For example, simple rules of capping the increase of G. And this particularly comes from the high non-linearity of the optimal policy. But what we are currently working on, just to put like a positive side on that, is introducing potentially additional frictions that can be connected to this. And here we show a model in which we wanted to show as clear as possible the trade-off between kind of the Keynesian side and the sovereign debt side. But there is, some things that we're taking as given. Let's say, for example, the impatience of the government. We're currently exploring more economies, an identical economy with political economy frictions. And in that case, you can have, for example, more of a case for fiscal rules to enter. We're also studying the case of private debt that I think it's very interesting. The way in which we thought about that, and that's the reason why we didn't end up focusing, is to some extent we have some data that is kind of the cyclicality that we see out there, and we wanted to say, can we identify some frictions that can explain that? But I do think that there's much role of understanding the kind of the connection between private and public. And as you're saying, right? So here in the model, what matters is the exposure of public debt. Then to the extent that the public debt has some linkages, as in the case of Spain with private debt, there could be kind of more interesting elements to analyze. Enrique, so here we are considering a utility cost. So there are two costs of default, the exclusion, and there is a utility cost of default. The reason why we model it that way is that in a model with two sectors, we didn't want to take a stance in exactly on how much you affect tradable output, how much you affect non-tradable output, because that could have on itself consequences on the real exchange rate. So we started that way, but then we realized that that wasn't innocuous. So we wanted to have, we thought it was kind of a cleaner model for this, just for the case that we have two sectors, right? So we know very well how the model works, usually with kind of trail goods, but here in this case we wanted to, especially for the type of policies we want to consider, we wanted to abstract from that. And that's the reason for considering kind of a utility cost. And Fernando, thanks a lot for the comments. And regarding the slope, so what we're plotting here is like think about first in the economy without default risk. So there are here decreasing returns. So as you vary the level of Y, you also start varying that slope. And then there are of course there are more nonlinearities entering into the case of sovereign risk.